Today, I am here to sound the alarm on America's unsustainable national debt. America's fiscal house is not in order, and a US recession that triggers a US default will sink the global economy. This is the mother of all crises. Let me start by looking at a few hard facts just to put in perspective how serious this situation has become. America's $35 trillion worth of government debt is now the largest in the world. It has also surpassed the size of the US economy. We are now looking at debt levels that are above World War II, and by 2053, debt to GDP will be at 200% of GDP. These are some shocking numbers. If we think about the CBO in terms of projections over the next 10 years, they expect that annual deficits will double, interest expense will triple, and for every $0.50 that is borrowed by the US government will go towards paying down debt. And over the next 5 years, interest expense will be larger than the US defence budget. The biggest drivers of debt growth is mandatory spending. And that mandatory spending is on healthcare and social security. And over the next 10 years, mandatory spending is expected to be 90% of government spending. And that is with no offsetting revenue growth. And what we see over the next 10, 20, 30 years is net interest starts to consume the budget. And this is where there's some shocking numbers. If you think about healthcare and social security, net interest starts to surpass social security in terms of government spending. And the two most alarming stats that I found when looking at government debt was by 2031, America's Medicare hospital trusts will be insolvent, gone. And by 2033, the Social Security Trust Fund will be dried up. These are very concerning numbers when we're looking at government debt and the budget. There is a limit to this fiscal spending, and that is debt sustainability. And that all depends on future income growth. And the key statistic here is nominal growth versus the level of interest that the government pays on its debt. And what you can see in environments like early 2000 through the GFC and the COVID crisis, we saw nominal debt fall below the rate of interest. And this is where debt actually becomes unsustainable. So there is a need for the US government and the Federal Reserve to run this high-pressure US economy. And if they don't do that over the next 5 to 10 years, we are likely to see debt to become very unsustainable. Beware of US recession. We've been talking a lot about the probability of growth in the US actually really starting to disappoint here. And a US recession that takes debt and deficits to even higher levels than is projected will cause a US default. This is our US recessionary dashboard, where we look at 20 different leading indicators of US recession. And what it's showing today is that 10 of these leading indicators have started to flash red. So that's suggesting that over the next 12 months, there is a 50% chance of recession. And this is where the vulnerability for the US economy has never been so high. A US credit rating downgrade looms. Here we're looking, on the left-hand side is Moody's US credit profile, and looks at 4 different factors. And you can see that fiscal strength is of very low quality, Baa3. And if you look at the median AAA countries by Moody's, the US has the worst debt burden. It has the lowest debt affordability than all AAA countries. And the risk is that if we continue to see this deterioration in fiscal strength, The US's economic strength, the exceptional economic strength we've seen over the last decade, will come into question. And the deterioration in fiscal strength will just no longer be enough to maintain that AAA rating. Enter now the bond market. And this is where bond markets will always win. And I have to say that because I'm a bond investor. But what we saw back in 2022 was an environment where we saw the former PM, Liz Truss, try to push through unfunded tax cuts. We saw a huge spike in gilt yields. We saw a collapse in the pound. And this is where bond markets make sure that governments actually pay for that. There's a higher risk premium that's required by investors to be lending the government money. So there are 4 key scenarios that can play out in terms of a US sovereign default. Firstly, a growing debt burden. In this environment, we see US leadership being challenged. We see a weaker US dollar, and we see borrowing costs continuing to move up. In a default, we see a huge destabilisation of the global financial market. Again, a question on the US dollar in terms of the world's safest asset and the reserve's best currency. A default-induced downturn will also infect those other countries that are very fragile, sending the global economy into a broader recession. And lastly, the mother of all crises is where we see a deep recession in the US that triggers a US default. This is likely to sink the global economy. And in all these possible scenarios, it's an environment where we see interest rates rise, borrowing costs moving up. We see credit markets start to freeze up and equity markets collapse. This will be the biggest response the Fed will have to deliver to stabilise markets. And there is a question here as to whether the US Fed can even protect the US economy if it defaults. What are the investment implications of this prediction? Well, it's obvious in terms of global diversification outside of the US. We want to be investing in non-US dollar denominated assets, investing in European or Australian equities or credit markets. Government bonds are likely to underperform initially, as investors want higher compensation to be lending the US government money. But with the lack of fiscal inability to respond to such a crisis, especially in an economic downturn, government bonds will start to become more supported. It's an environment where we'd see a collapse in the US dollar. This would accelerate inflation. So there'd be a need to have more inflation protection in your portfolios, owning inflation-linked bonds, commodities, gold, even real assets. Asset classes like real estate or infrastructure that will hold their value better in a downturn. It will be value over growth equities. It will be active over passive. And we should be starting to think about moving away from this 60-40 traditional portfolio. And in closing, if there's one other real reason why we should be very worried about a US sovereign default, is Donald Trump. Because it is Donald that knows a thing or two about defaulting on debt. Thank you.
Thank you, everyone, for coming along to listen to us do our shocking predictions today. So there's been a lot of talk about AI today, perhaps unsurprisingly. But if everyone just closed their eyes for, 5 seconds and just imagined what they think AI actually looks like. And I reckon most of you in this room probably thought of something like this. I was going to put a picture of Arnie with only half her face from Terminator 2, but I didn't want to scare my childhood self. So this is what most people think AI looks like. What AI actually looks like is this. A massive data center in the middle of the US. And that's because AI is about building that infrastructure layer, rows and rows of computers. And that takes an incredible amount of power. It takes an incredible amount of computing power, but actual power as well. And the cost of running AI-driven searches is just going up and up. If we look at this chart here, ChatGPT actually takes 10 times the amount of energy to do the same search as a traditional Google search. And then an AI-powered Google search takes 30 times the amount of power. So there is this impost, this power impost associated with the growth of AI. Power is actually not that big a deal in the context of the total amount of money that's going to be spent on AI. Power is a small part of the value chain there, but it's an important part of the incremental energy demands that our society is going to be facing. But it's actually small in the scheme of things. Data centers are 4% of our energy load. And yes, they're growing at 25%, but there is all of these other imposts on our energy load as well. Reshoring of manufacturing, EV charging stations, the emerging middle class, buying an air conditioner for the first time, heat waves, hydrogen-generated fuel, transport, and of course the investment in renewables as well. Because not only is our energy load going up over time, it also needs to be renewable. So there's this double problem to solve. And the solution is going to demand more power off of us. This is going to drive a huge scale of investment. So yes, AI hardware, which the whole market is enamored with, is going to be a huge investment cycle, $2 trillion through to 2027. But that scale of investment is dwarfed by the amount of investment required in the energy transition, not only in the US, also in Europe and in China as well. That cumulatively is $18 trillion over the same time period that these economies are going to need to invest. And that's only to reduce our carbon footprint by 25%. That's not even going the whole way to 2050. How is this going to play out? So the energy transition will be the investment cycle to power the next decade. As much as we are enamored with AI, this cycle is bigger and it's durable and it's happening right now. Who's going to do the heavy lifting here? This is probably news to nobody, this chart. It is going to be through wind and through solar. Right now, wind and solar are 9% of our energy supply. That's going to grow to over 20% by the end of the decade. It's going to grow to over 50% by 2050. And that's going to usurp, coal, obviously, which is 20% of our energy load today. And the other thing to consider here is that it is backed by government policy. Fiscal spending is incentivizing companies to invest behind this shift. You can see this as an example in the US market in particular. But the other element of this is that government policy is incentivizing corporates to invest as well. And our very favorite AI companies are actually establishing power purchasing agreements to fuel the investment in renewables as well. So this is happening not only backed by corporates, but by governments as well. And it is a global phenomenon. Those blue and green bars are the US and Europe, and of course that investment in renewables is going to step up, as we well know. But you can see that's actually dwarfed by the red bars there, the Chinese bars. This is an example for Xi Jinping to demonstrate to the world the power of that central party control, harnessing the sun from the Gobi, the wind from their mountains, the water power from the Yangtze, and creating an end-to-end grid of baseload power in China. And they're actually going to get to 40% renewable by the end of 2025, which is just an incredible statistic. As you can see, that shift is blowing, the EU in particular out of the water. And they need to do this because there's a cost issue here. And they're actually also, their need for energy is going up and up. They're actually adding 70% of Japan's total power usage, they're adding to their base every single year. But this is not just about jumping on a bandwagon, yet another investment theme that's going to be enormous, and the scale of investment is huge. And it's the classic way that investors can, get exuberant and tend to overpay. What we're looking to do here is take that pragmatic value approach, find value opportunities across the value chain of an investment cycle. There's a few key ways we can do that through enabling materials, beneficiaries of investment in sustainable materials, through power utilities where they'll get a regulated return on investment in that renewable power space, as well as enabling technology, providers of the products and solutions to address our energy needs. And there are here and now opportunities that we can participate in across that value chain. Enabling materials such as copper and aluminium, investment in power utilities that will get that regulated return on the investment, and of course, enabling technology, be it grid investments in China, investments in factory automation, smart infrastructure, the making of EV, charging station infrastructure, as well as companies that are involved in hybrids. And to sort of bring that to life, let's not overpay, electric vehicles, the elephant in the room. This is an area where people have gotten really excited in the past. And, let's just go for the jugular here, with the head-to-head of Tesla versus Hyundai. You don't have to overpay to participate in these investment trends, even if there's this big investment, exciting tailwind to be found. 75 times there for Tesla. What an egregious multiple to pay for an EV-only company, losing market share in the US, participating in the bloodbath that is the Chinese EV market, facing margin pressure from reducing their prices and that increased competition. And of course, their supreme leader, there's no corporate governance to speak of. You can pay less than 5 times for Hyundai, has that all-weather powertrain portfolio, has that EV exposure, but importantly, that hybrid exposure as well, which is gaining share as we make this transition to battery-based technology. They're present in 200 countries around the world, in countries like India, which are growing, in places like the US, which are growing, and there's a capital return story attached as well. So the reminder here is that you should pay the right price for exposure to these trends and not overpay. Just to bring that together, the energy transition is a multi-trillion-dollar opportunity. It's bigger than that of AI, and it's being unappreciated by the market. It is global in nature. It's being backed by corporates. It's being backed by government investment. And there is compelling valuations to be found across that whole value chain. Thanks very much.
Well, as Vihari said, there's been a lot of talk of AI. My thesis today is we are at peak AI right now. It's really hard to make money out of ideas, investment ideas that everyone's talking about. The way you make money is about the ideas that no one's talking about. What I'm going to talk to you today is I'm going to look back through history. What we are seeing now is actually been happened many times through history, and I'll take you through some of the episodes in the past. So if you look at all technology disruptions, they rhyme. There's a same theme to all of them. There's a very exciting new thing. There's heavy capital investment comes out behind it. There's large investment gains for early investors. We've seen that already. And then there's the inevitable bust. But actually, the news is good. In the long term, you get huge benefits to society. You need that mania. I think Zuckerberg spoke about this recently. We are in a sort of a mania, but you need that mania because that's what brings the capital and brings the long-term benefits to society. The examples I'll talk to you today are railroads in the 1850s in the UK, the internet in the late 90s, and where we are today. So I love this quote. This is from a publication of the time of the 1840s. Railways will forever change the pace of human existence, the length of our lives, so far as acquiring information and disseminating power will be doubled. And we may be justified in looking for the arrival of a time when the whole world will have become one great family, speaking one language, governed in unity by like laws, and adoring one God. There's always a big claim when this happens. Then the railroad boom turned to bust. The shares actually fell 85% from their peak, and actually at the bottom were valued at half the capital that had been invested. And the receipts per mile fell by 33%. It's a structural thing with all of these booms. Capital comes in. You can't avoid the capital cycle. The more that capital comes in, the returns fall. But actually, this is the good news. 8,000 miles of track were laid, the highest density in the world, 7 times more than France or Germany. And that formed the backbone of the modern revolution of the UK economy. Let's skip forward to the late 90s. Yet again, unfortunately, I lived through this. This was a big claim as well from Nicholas Negroponte. I love this one. Digital living will reduce man's dependence on time and place, close the generation gap, and lead to world unification. Probably want to get our money back on that one. And look at it, it's incredibly exciting. Look at that run there in Cisco, 25 times your money in 5 years. And then what? Boom. So it lost 85% of your money. So let's just go forward now to our time, artificial intelligence. I love some great claims here. Bill Gates, not one to be outdone. Biggest productivity advance of our age. We will work less, we'll be richer. This is good. And then we get on to Kellie Wood's, never one to be outdone. GDP growth will go from 2 to 3 to 6 to 9. And then we have Elon. AI will eventually eliminate all jobs. There will be no shortages of goods and services. So there's always these big claims. It's very exciting. And there we go. Boom. NVIDIA. Actually, interestingly, up 25 times in 5 years. You see a bit of a parallel there? That's Cisco and NVIDIA. Previous 5 years, overlaid from 95 to 2000, NVIDIA now. So I don't know how lucky you feel, but that's quite high heights up there. And you're obviously saying that history is not going to repeat. But this is something more to think about. This is from Gartner, something to think about. 30% of Gen AI projects will be abandoned after proof of concept by 2025. Many will fail because of poor data, inadequate risk controls, unclear business value, or escalating costs. Now, one of the things with bubbles is it doesn't take much to prick that bubble. It could be a recession, it could be a missed earnings number, it could be a drop in capex, it could be a war. If you look back through history, it doesn't actually take much, and then the whole mania that built up unfolds through time. So there you see, and I think this is such a good way of looking. It's called the Gartner hype cycle. So you can see, I think we're now at peak inflated expectations. That's where we are now. Then you get the trough of disillusionment. Who can forget Amazon dropping 90% after in the late 90s, and then it went on to much bigger and better things. And I'm not saying that AI is, it's just that at the moment, there's a good chance you could lose a lot of money. It's not saying in the long term, it'll actually be great for society. This is actually just looking back to the late 90s history. It doesn't repeat, but it does rhyme. And this is from a Barron's cover in December 99. I remember this coming out, and the headline was, "What's wrong, Warren?" saying that he had kind of lost his touch. And actually he had a bit. Actually in 1999, he was down 20%, the blue line. The market was up 20%. It's a 40% differential. There you go. Through the cycle, Warren, as usual, came out ahead. Now, this is an active quality growth proxy from the time. I look back at it. It was actually my previous employer. And you can actually see there in 96 to 98, they were holding on by their fingertips in the bull market. We came to 99. They were down 7. The market was up 25. Tough times. Boom, the thing bust. The next 2 years, they outperformed by 30 and 11%. So I think this is a time to be very cautious, be careful about buying into the hype. It's peak AI, and it's time to buy quality growth. Thank you.
Thanks for the introduction. You'll love this, Bob. A few similarities in there. I was thinking the great privilege in what I get to do is that I'm just immersed in markets all day, every day, in front of companies all day, every day. And I think if you do anything often enough or regularly enough, it really helps inform your intuition, your pattern recognition, and ultimately helps you differentiate what works from what doesn't. So that's what I'd like to talk about today. I'd like to talk about it with respect to thematic investing. There's always a theme that's alive and well in the Australian market. As Bob's probably already pointed out, AI is the most prominent, seems to be the most popular. I got here late. I was amazed at how many times AI had been mentioned between when I got here and now. Things like the energy transition, battery materials would also be familiar to you, albeit investor interest has somewhat waned. And then you've got these mini manias, things like milk and marijuana, which sound a bit ridiculous now, but seemed much more sensible and legitimate at the time. If you go back and use dairy as an example, we got to the point where Jerry Harvey was buying dairy assets in his listed vehicle, Harvey Norman. Maggie Beer bought a dairy asset within her listed vehicle. Gina Reinhardt, again, part of the buying frenzy. But not all thematics work. So Jerry, I think, was all in for $75 million. That asset went into administration. Maggie Beer, last I looked, that asset was losing $28 million and was up for sale. And Gina's probably the smartest of all three because she doesn't publish her financials. Which leads me into my prediction, which is that thematic investing will perpetually underperform. So this is a graphic representation of what I think returns could look like in the future. They will be surely under market. So why do people do it? A simple, logical, tangible idea. It makes sense. You can see the thematic happening in the real world. The extension of that is if I can see confirmation of that thematic, the companies that are associated with that thematic will benefit from that. I think there's a bit of a flaw in that logic. One of the flaws is if you've had that idea, it's possible that you're not the only one that's had that idea. There's two key issues, I think, with thematic investing. One is behavioural. So just for a moment, just remember that a lot of these thematics, or all of the thematics, really start with a kernel of truth or a plausible premise, if you will. So that validates the thematic, creates positive price action. That in turn creates investor interest. That investor interest then translates into more price action. You can see where I'm going. You end up subject to confirmation bias because everyone else is doing it. You've got past performance as evidence of it working. And really all that does is culminate in hurting behaviour, which creates overvaluation, which turns into underperformance. The second of the two issues, I think, is the capital cycle. Thank you again, Bob, for stealing my thunder on this. More capital means lower returns. So best case scenario, more competition is probably your best case scenario, is that capital's deployed with companies who have more investor interest in elevated share prices, raise capital and deploy it. Your worst case is something where, use lithium as an example, an industry that has lower IP, is more capital intensive, results in overcapacity, and that can be disastrous for returns. Proponents of of thematic investing would argue, I'm not buying the whole theme, I'm just buying the best stocks within the theme. What I would argue is if you're not looking for sustainable competitive advantage as your first port of call, then you're just getting distracted. A few examples, again, going back to the dot-com bubble. What I think is really interesting here is everyone was right. The internet really did change everything. And despite that, you've spent 7 years enduring a lot of volatility for no return. Half the stocks that participated in that thematic were no longer in existence by 2004. And if your justification was that you were looking for the next big one, something like a Google, that wasn't even listed until well after all of the excitement had fizzled. Two of the most famous investors in the world, I think. One likes megatrends, the other likes moats. One has done less than half the return of the other with more than double the volatility. So I think that's a win for stock picking. And if you're a bit more data-driven than that, Morningstar have gone and done the legwork for us. The blue bar is thematic investments. They've done this across as many thematic funds and over as long a time period as they could get their hands on, and found that thematic funds significantly, I should say, underperform. So what do you want to do about all this? Well, I think we've already made the point that AI probably has the most enthusiasm and exuberance in the market at the moment as far as thematic investing goes. Only took me a few seconds to find a robotics and AI ETF. After a bit of Googling, unsurprisingly, the returns since inception have been below the benchmark. I don't see any reason why that would be different going forward. So step one would be just avoid thematic investments. If you want to do better than that, just buy the index. The index doesn't underperform. If you want to do better than that, again, find an active manager with proven stock picking skill. They can avoid pitfalls. Like Nuix is probably a good example. That share price has benefited significantly from the AI thematic, albeit its earnings haven't yet. It still makes barely any money despite trading on a $1.8 billion market cap. It doesn't look like a good risk reward to me. And if you want to do even better than that, you can find a manager that can profit from these overvaluations. So if there's one thing to remember, it would be thematics and thematic investings will underperform. So just stay away from them.
Thanks, Ali, and thanks for having me. I can see now why I've been put last. I might actually translate some of this fear into market fear. What I'm going to look at in the next 5 minutes is the difference between a cyclical bull and bear market and a structural one. So what you would know as a bull market is a market that has risen 20% from its bottom, and a bear market is a market that's reached a peak and fallen 20%. They're the general definitions of a bear and bull, or bull and bear market. What I'd like to distinguish, though, is a structural one. So if we look back, which is much longer dated. So if we look back a bit over 100 years and we look at the US market, and the reason I picked the US market, it's got the best data, and Australia's about 70% correlated on a monthly basis with the US. So on this first chart here, it's actually 103 years. The headline's a bit misleading, sorry about that. There is 4 structural, not cyclical, but structural bull markets that we've been through over the last 103 years. They're the green lines going up. That's the upward trend. Makes sense. There are 3 structural bear markets that we have experienced over the same period. They're the red lines that go down. Now, that one is inflation adjusted. So the one you would see, if you just looked at the screen over 100 years, is that one. Doesn't look as bad. If I flip back, you can see the downs are much more and the ups are pretty sharp. That's the one you would see. And it levels out because it doesn't take into account the dilution that you get from your returns from inflation year to year. So we've had they're long and structural. So what do they actually look like? So there's 4 bull markets that we've had in the last 103 years. So this is the Dow. Why I picked the Dow is because I know it's not the perfect index, but what it is the longest data set that we've got. It's been in existence the longest. It's always had around the 30 companies that represent the American market. Not perfect. The S&P came in slightly later, so I thought this was a better one to look at. The average length of these bull markets are 14.6 years, and the shortest one was way, way back in that first one, 21 to 29, the lead up to the Great Depression, and it was also the sharpest, went for 8 years, 10 months. Then we had, in the 3 bear markets, they actually slightly longer, 15.1 years, and on average, and the shortest one was the one we've all probably lived through, or most of us, 2000 to 2009, tech wreck, eventually capped off on the other book ended by the GFC. And we know how bad those 2 moments were, but that lasted 9 years. So what does it look like in numbers? The 4 bull markets, and this is inflation adjusted, the top one, go up on average 4.27 times. So it goes from $100 up to $427 without inflation. So what you'd see in your bank account, up 7.3 times over those average 14.6 years. The 3 bear markets, which go a bit longer, as I said, on average, inflation adjusted down 61% for the periods, and without inflation, 37.5%. So over 15.1 years, that's how much money you would lose from start to finish. And that's happened 3 times in the last 100 years in the US. So the current bull market that we're in started in 2009, March, after the GFC found a bottom. It's been going ever since. Now, I know you'll say, hold on, we had COVID and we had the interest rate rise in 22, markets fell by more than 20%. But if we go back to the charts, you can see up in the right-hand corner there, it didn't stop the upward trend in the bull market. It was a correction. It wasn't a structural change in the market. So if I go back to the final slide, we are currently at 15 years, 5 months since March 2009. Inflation adjusted return, now this is the Dow, is 2.7 times, which is less than the average. And without inflation, it's 4.1 times. But we know the indexes have changed, and dramatically over the last couple of decades. So if you look at the other big indexes in the US, the NASDAQ, so this is without inflation, 11.8 times, greater than the average. And the S&P 6.3, getting very close to that 7.4. Now, does that mean the market's going to fall today? I don't think so. I'm actually bullish. I think we're in a cyclical bull market where interest rates are being cut. The next 2 or 3 years will be very, very good for markets. We're on the record saying from late 2022, we thought the market had bottomed. So I think you've got another leg up. But what I'm saying is we're very, very late in the structural bull market. It could last 2 or 3 years. What happens at the end of that? Well, history tells you that we will probably enter a period somewhere around 15 years where you won't make money. There'll be periods in that where you can. There'll be years that bounce off a bottom, but you'll have to play defense. Very few asset classes will work. And what's the trigger? I don't know. Like Kellie's assessment of sovereign debt could be the trigger. Normally debt plays a role. We saw that in the GFC. We saw it in the Great Depression in 29. You will have to play defense. Cash will probably be the only asset class that sees its way through properly. They'll be all relative. The higher the growth, the worse you'll do. You'll have to pick your own portfolios defensive, and you'll have to pick managers, if you use them, as also being able to play defence. So it is going to be a really, really tough period, and the people who come out the other side will be the winners. There'll be a lot of carnage in between. So that's my shocking prediction.